to the next episode of Just Peachy. I'm Peachie Thompson, and I'm your host. Just Peachy is a show where we interview leaders and subject matter experts in the fields of insurance, finance, and taxes. Today, we're going to talk about inflation, and it is my pleasure to introduce you to our next guest speaker, Mr. Blaine Thiederman. Blaine, welcome, and thank you for joining us today.
Thank you for having me. I'm excited to be here.
Yes. So, Blaine, you are from Colorado. Tell us a little bit about yourself, your firm, and everything that you want our viewers to hear.
Well, my name is Blaine Thiederman. I own Progress Wealth Management. Progress Wealth Management, we're a fee-only financial planning firm. We specialize in working with high-earning individuals that are successful, typically highly educated as well. And they normally have got some aggressive savings goals in life. Sometimes this might be helping out family because they need to be able to help pay for their parents' retirement. Sometimes people have a goal of retiring really early. I've got some clients who want to retire as early as 45. How wild is that? That's exciting.
Yeah,
Uh,
45.
exactly. Now, a couple things that we really differentiate ourselves with. Number one, we don't believe that any one person knows it all. We believe that every client that we work with deserves to work with a specialized professional in every area of the financial plan, so they get the best advice about everything from taxes, because we employ our own tax expert, to estate planning. We have our own attorneys, to insurance, to so on and so forth. So this is part of the reason why we believe that really just end of the day, what the best you can really do is as a result of the best advice you can possibly get. So that's really the whole
It
shtick that Progress Wealth Management has.
makes sense. Makes sense. And Blaine, how did you get into financial planning?
I got into financial planning because I was working as a broker at SkyTrade, and every day I'd go to work and I would see people making terrible mistakes with the way they managed their money, the way they managed their retirement plan. And these people would be buying penny stocks with their Roth IRAs
Hmm.
and rolling the dice with their life savings. And as a result, I saw so many people just ruin their financial futures and even their kids' financial futures. And I myself am even a victim of this. My grandpa, he threw away over $2 million in the stock market thinking he could figure it out. Not at
Wow.
all uncommon.
Right,
So
right.
I got into this because I wanted to help people figure out how to avoid these big mistakes. And it's not just that, but taxes can be a mistake, insurance, so on and so forth. All these things people have no idea about, and they need someone that they can trust. That's the goal.
Absolutely. Absolutely. So that's very interesting. So we are here to talk about inflation, and mostly I want our readers to hear about what they should be cognizant about. As you know, inflation is everywhere right now. And what countermeasures we can do as consumers as far as, making sure our finances are okay. You mentioned giving the best advice and making sure that things are in good order. So, what happens if someone doesn't do proper strategy to ensure that their income and assets grow as fast or maybe even faster than inflation? What are some of the things that could result if someone doesn't do that?
Well, that's a great question. Well, financial planning is filled with a lot of if, ands, maybes, and sometimes. There's no real silver bullet or standardized problem that happens to every single person. For some people out there, some people work for the same company for 30 or 40 years, maybe getting a 1 or 2% raise a year, and you slowly but surely throughout the last 30 or 40 years, you probably see that your paychecks don't pay for as much. Needless to say, what that means to you is it's harder to save. It's hard to live the life that you've grown so used to living. It's hard to afford to just go on vacations or do fun things. And needless to say, that's a big problem because this is the only life we got. And it's really nice to enjoy it as best we can. So the big problem there is it just costs you happiness by not having your income keep pace with the cost of living. And then there's some people out there who invest way too conservatively when they're retired because they think I'm retired, therefore I should be investing conservatively. They're not entirely wrong, but there is such a thing as too conservative. Nowadays, if you invest too conservatively when you're retired, well, what does that mean to you? It means your investments don't keep pace with the cost of living. It means that that retirement that you dreamed of, the retirement that you hoped that you're going to enjoy, you might not enjoy it as much because maybe you won't be able to go travel to see your grandkids. You might not be able to go on those trips that you dreamed of because you'll have to pinch pennies in retirement, and that's not what anybody wants. So those are the kind of problems that really can
Right.
result from just not having a good strategy for your lifestyle to keep pace with the cost of living.
So yeah, let's break this down into two parts. So the first part really is someone who's still working, right? And considering that employers don't usually give raises as much as the cost of living. Nowadays we have an awesome employment market, right? There's a lot of jobs right now. But how can someone ensure, what are the things that they can do to make sure that the income keeps pace with or preferably outpaces inflation?
Well, so first of all, last year inflation was about 7.5%, and this year it's already higher than that.
Mm-hmm.
And I don't think I've heard of a single person that says, "Yeah, Blaine, I got a 7.5% raise without getting a promotion. My company just gave it to me." Nobody got
Don't we
that.
all wish? Yeah.
That'd be
Oh,
fantastic.
yeah,
But
that'd be
that's not the
fantastic.
case. It's not the case at all for just about anybody. So how can we ensure that our cost of living keeps pace with, or preferably outpaces, inflation? One thing you can do is you can go on the internet and you can go to websites like payscale.com or salary.com, and they have free software that you can use to analyze your earning ability given what you could get out in the market these days. Because maybe your current employer won't give you that raise, but maybe if you left your company, they might. And it's not to say you should leave your company, but it's to say that you should hold your employer accountable for being competitive. If you're a good, loyal employee, they should pay you what the market pays you. So you can go get that analysis. You have the data in front of you. And you can approach your employer and say, "Hey, if I was to get a job at all these other companies, they would offer me this much. You're offering me less. What's up with that? I thought you liked me." And they can say, "Well, you know what?" And that'll probably make them not exactly happy, but at the end of the day, they got to pay you what they got to pay you. And if they're not happy with it, you go and they say, "No, we're not going to pay it to you." Well, you have a clear indicator of whether it makes more sense for you to stay or leave. You might still stay, even if they're not paying you what the market pays you. But just keep in mind, 2, 3, 4, 5, 6, 7, 8, 9, 10 years where they're not keeping pace with the market, it would hurt your future. You care more about your future or your employer? That's something to ask.
The company also has ways to identify which employees must have a raise or can't have a raise, right? And they must make business decisions based on that. They need to give raises to employees who deserve it. They also need to keep up somewhat with inflation. And I've been in companies where we were able to give just 2-3%. This is, and I'm talking about maybe 10, 15 years ago. Now,
Mm-hmm.
if I give 2-3%, as we all know, that really doesn't cut it, right? So part of it is, yes, you can leave your company and or you can stay with your company and think what is most important to you, right? At least
Absolutely.
that's what my take is on that. It's there's lifestyle that you have to take into consideration. The salary, of course, and the commute, the whole shebang. So yeah, so let's pivot a little bit. What about you talked about retirees, right? So the retirees now they're having their pina coladas on the beach, and you're thinking, oh, this is life, and I really don't want to risk too much. And understandably so. You want predictability when you're at that stage in your life.
Without
So
a doubt.
what would you say to someone who's a little bit afraid to take a little bit more risk? What are the things that you've done or you've suggested to your clients?
Well, as everybody knows, the goal when you're retired is to make it so the money you do spend, you try to spend most of your money on fun things. That's the goal. So that's why a lot of retirees, first off, in order to try to decrease their risk in retirement, they aim to pay off their mortgage. Because less money you have to withdraw out of the retirement accounts, that makes things easier. It makes it easier for you to stay in a lower tax bracket. It makes it easier for you to not hope that the stock market does better than whatever interest rate you have on your mortgage. It makes a lot of things easier. And also, it just makes it so you enjoy your retirement more. You don't have to worry about money as much if you don't have a mortgage. So first thing I do with every client I work with is I always recommend, let's try to aim for a strategy to pay off your mortgage, hopefully before you retire. Now that's the first step. Now let's say, for example, if you've got your mortgage paid off, you're getting $60,000 a year as a household from Social Security, as many people do.
Mm-hmm. Yes.
Um, what if you need 80? What if you need 90 in order to really live the minimum lifestyle that you want to live? Maybe you've got major healthcare costs that are ongoing. Maybe you've got to help out a child who's got special needs, and that's really expensive. So on and so forth, whatever that might be. Well, if you absolutely need a minimum amount of income of $90,000 a year before taxes, well, maybe it might make sense for you to also maybe buy a fixed annuity to help cover that, so you don't have to withdraw in the middle of a bear market to pay your bills. So just whatever your minimum expenses are, I typically aim to cover with some sort of guaranteed source. Now, everything above that, because people have their bills guaranteed, a lot of retirees, if they've got the stomach for it, we might put them into something a little bit more heavy in the stocks. Main reason being is a lot of retirees these days have a goal of leaving money for their family. Because with how
Sure.
difficult life is to afford these days, and how they know they're not going to be there to help their kids out when they're gone someday, people say, with enough money being left to them as an inheritance, I can guarantee that they're going to be okay, even when I'm not around, or at least do a better job at it. So that's oftentimes why a lot of retirees still like a lot of stocks. Now, if that's not a goal, and they just want to sleep well at night, still important to keep pace with the cost of living. And still having some stocks in there is important, but probably not too heavy. Just to make sure that they're still keeping pace, but they're not rolling the dice with anything.
So you definitely touch a lot of items there, right?
I
I could
did.
already hear someone listening to us saying, wow, I never considered even thinking about stocks after I have sort of, well, when I have retired, right? Or you're thinking, I need to be more conservative, more conservative. At least that's 90% of the retirees that I've spoken with and some of the people that I've come across. So what is something that, like, when someone comes to you and say, hey, Blaine, I hear it, I hear you, but it's very difficult for me to wrap my head around, at this age, at this stage in my life, I have to still play the stock market, right? That's like one of those things that might keep me up at night kind of conversation with some folks.
The real risk we all should be concerned with is not the markets going up and down, even though everybody doesn't like that, and I don't blame them.
Yeah.
But the real risk we all have to be concerned with is running out of money someday, or our family that we want to make sure are going to be okay when we're gone, them running out of money. Those are the real risks. Because as long as you're diversified, we've never ever had a broad market collapse where everyone lost their money. It hasn't happened once in history, ever. So long as you are diversified. The people who really are quote unquote risky are the people who put too much money into one company or one industry. Those are the people that are not being reasonable. But the people that are broadly diversified among thousands and thousands of companies, they're not risky at all. They're just going to see the markets going up and down. The big risk they have is, what if they sell when markets are down? Like right now. If you're selling right now, well, what are you going to do to make your money come back? Because
Yes.
you might have cancer someday. Cancer is expensive to have. It can cost hundreds of thousands of dollars. If you had
Yes.
to pay that, what are you going to do to afford the rest of your life? So that's why I say it's important to think about, well, what could your future hold when you're figuring out a financial plan? How expensive could your future be? And what's the cost of living going to be? Those are the two big risks you have that you have to think about as a retiree.
Right. So
So
diversification really is a key. That is truly across the board. I
without a
am a
doubt.
big believer in diversification, and I do hear a lot of the concerns of retirees are outliving their savings.
Absolutely.
It's what keeps most people up at night. Is I've had enough savings. However, my mother lived to 95, 96, and who knows if my money will last till that age, absent any surprises with health or accidents or anything that will prevent them to live their true life expectancy.
Yeah.
So Blaine, I'm going to pivot back to our younger folks, right? So you have sometimes single income, and sometimes you have dual income. But when does it make sense for someone to consider getting a second or even a third job?
Well, nowadays there's this new movement called overemployment, and it's completely 100% legal and it's completely feasible. A lot of people, at least at one point in their life, they've worked with somebody who works their 40-hour-a-week job, but in reality is only productive for maybe 10 or 15 hours. I hear this all the time from my tech employees that I work with. They don't have enough work sometimes to fill up a 40-hour-a-week job, especially software engineers and project managers. And they say, well, what should I do with the extra time? Should I just ask my manager for more work? When I ask them for more work, they normally don't even give me more work. So should I just sit around and play video games? I'd like some more money. That'd be a lot better. So what can they do? Well, some people will end up getting maybe a remote job. And maybe their job that's their primary job is remote as well. And the two, they can coordinate schedules. Sometimes one job will just give them projects, and the projects will be due at a certain time. They can work on those projects. Me, myself, I teach CFP courses and securities licensing courses for Kaplan. And I also run and operate my own firm. I've got a successful firm. I've got a lot of work to do, but I don't have always 40 hours a week of work. Why not make a little extra money? And the main reason why this is helpful is when you've got expensive goals, when you've got expensive lifestyle, sometimes it's nice to be able to make a little extra money. So me, myself, my goal is to help be able to pay for my mom's retirement. My mom's got a lot of health issues. I'm trying to be there for her. I don't need the extra money. I'm just trying to make it so that I can be there for my mom. And this is a goal of a lot of people, right? So when does it make sense to consider getting a second or a third job? Well, if you work remotely and you're trying to make sure you help family out, maybe you're trying to help save a little extra money for your kids' college that you couldn't afford just with the salary of one job, it can be really helpful. Or if there's a second job you have that maybe you work on weekends, or maybe in what free time you have, it can even be a part-time job. That can help make sure that you can afford life even with inflation going crazy like it has. That's when it can make sense.
I hear you. Hear you. So everybody has heard about 6 to 12 months of savings is prudent, right? It's expected. Have it in your bank account for rainy days. Now, Blaine, with inflation as high as it is, and banks paying close to nothing, when is it smart to adjust this way of thinking?
Well, so 6 to 12 months is the rule of thumb. But like I said earlier, financial planning has a lot of if, ands, maybes, and sometimes. And we can't always depend on silver bullets as we plan our financial lives. Some people out there say, Blaine, I'm an incredibly employable person. I've been doing what I've been doing for a long time. I get recruiters annoying me on LinkedIn all the time. If I needed another job, I could just email 20 recruiters and I'd have another job by the end of the day, making just as much. So why do I need 12 months of savings in my bank account? That's a lot. Or even 6 months. Um, there's really not a lot of good arguments there for that. The only time you'd need that if you were in that kind of scenario is if you were preparing for medical bills or maybe major repairs on your home that could cost a lot. And with that being said, there's been a lot of studies on what you can expect for medical bills. So of course you can go look at your actual health insurance policy and it says max out of pocket. That could be your emergency account right there actually. If you're only concerned with medical bills and you have a brand new place, max out of pocket. That would cover deductible for your homeowner's insurance, for your auto insurance, and also cover any healthcare costs. Right then and there, you're prepared. If you're not worried about finding a new job, if you were laid off. And then the other side of things, if you want to be a little bit more conservative than that, well, you could say on the high side of things, how long could it possibly take me to find a new job? Well, I've got some software engineers I've worked with that would say, if I really wanted to hold off for the right job, not just any job as an engineer, but the right job, it could take me 3 months. Because then I could get a job with maybe one of the other FANG companies, Facebook, Amazon, Apple, Netflix, Google. Or maybe I'd hold off for maybe 2 jobs, like I was mentioning earlier. Could take a little longer to find both. But smart to adjust this. Long story short, when you think that maybe 6 to 12 months or 3 to 6 months is way more than necessary, and you don't think you've got the risk of worrying about healthcare costs, finding a new job, if you don't think those are real risks for your circumstances, then you can adjust it to what you think is appropriate.
And what do we do with the extra?
With the extra? Well, it
Yeah.
depends. So first thing a lot of people do is if you have a hard time affording putting enough away to get your full employer match, bump your 401k contribution up to what your company's willing to match, and then just live a little bit on savings and dig into it every month until you've got that money from your bank account into your 401k and you got matched, because that's 100% rate of return right there. That's a nice deal. Next is, if you have debt that's charging you 10% or more, well, use that and just pay off your debt. You're not going to get 10% in the stock market on average, more likely than not. So might as well just pay it off. Now, after that, a lot of people will end up putting money into HSA accounts, health savings accounts, as long as they're on a high deductible plan and it's prudent to be on one. And HSAs, you put it in there. It's called an above-the-line deduction when you put it in, so it lowers your income dollar for dollar in the IRS's eyes. Saves you a lot of taxes. Then it grows tax-free like a Roth IRA the rest of your life. And between now and the end of your life, you don't pay taxes on anything that happens inside of it. So it's called triple tax-free for that reason. I have a lot of my clients use their HSAs for retirement as well. Keep that in mind. And the last thing that you can do is you can go set up a brokerage account. And you can go set up a brokerage account at any old broker, Fidelity, Schwab, Betterment, so on and so forth. And when you set up a brokerage account, what you can do is you can invest it, and it can grow. So it's probably going to grow better than a bank account as well. And the main reason why that's helpful is, again, cost of living is not going to stop going up anytime soon. It's nice to make sure our savings goes up with the cost of living. Bank accounts aren't going to do that for you.
Right. And,
So
and really, those are some of the unique ways that someone can ensure that the growth of savings could outpace inflation, right? So you've talked about a little bit of that. Are there any other stuff that you want to share with our listeners as far as making sure that the growth of our little nest egg here is on par to hopefully outpace inflation?
there are some unique ways out there. There are, and it's important once you've put away enough for retirement using the boring ways that everyone's heard of. ETFs and mutual funds,
Yes.
using the right accounts like I just
Usual.
mentioned before. What are the unique ways? Well, some people are interested in getting into rental properties. Sometimes rental properties can make a lot of sense, but I wouldn't recommend anybody put more money in there than they can afford to lose and still be on track for the future that they're hoping for. And that's the more difficult one to figure out. How do we end up making sure that the amount that we're saving here isn't going to end up, is still going to keep us on track? That's the difficult part. But rental properties, you have 5 times leverage on rental properties. And Utah this year, for example, Zillow estimates Utah is expected to have about a 12% growth rate. So that means if you have 5 times leverage, 5 times 12, well, that's 60. That's a 60% rate of return. And
I'll
that's
take
just
it.
betting on real estate in Utah. That's a good amount of money. Of course, that's before costs and expenses, but still,
Sure.
60% is 60%. Some people like to start small businesses, and some small businesses can actually pay very well. Just depends on how much time you're willing to put into it. But there are people who make a lot of money holding a podcast. Some people make a lot of money holding an e-commerce business, so on and so
Right.
forth. These are all things to think about.
Right.
And the last thing that's a little more unique, if you're not looking to start doing rental properties or starting a business, because that's a huge, some people really like,
Undertaking.
yeah, it's a huge undertaking. It's a lot of work. Some people really enjoy just going into maybe things like I-bonds. You can put 10 grand into an I-bond. It's not the most amount of money in the world, but nowadays they're paying almost 10%. And it's backed by the federal government. That's not going anywhere. That's kind of nice. Some people also as well like to get into alternative investments. You can invest in wine, you can invest in art via actual funds. So these are kind of things to think about as well that have actually done decently.
Right. So
Mm-hmm.
those are some really cool stuff towards the end there that you mentioned, especially if someone is passionate about something, right?
Absolutely. If you
We
can invest
we
in
could
wine and get some interesting stuff in there, not just in your not just in your not just in your pantry either.
your pantry, right? Yes. So we could talk about this all day, Blaine, especially with the way everything is going on around us right now, the markets, the all the financial factors that come into how inflation is really scaring a lot of people. But unfortunately, we have to end somewhere, right? So if someone has any questions and they want to get in touch with you, what is the best way for them to do that? How do they do that?
Well, so first off, I have free initial consultations with everyone, and I'm not a good salesman, so it's not a sales pitch or anything like that. It's really just trying to see if I can help you. But if someone was interested in getting in contact with me, you can go to progresswealthmanagement.com, and you'll see Contact Us, and you can pick out a time to schedule an appointment with me, or you can just call me at the phone number. It's listed right on the website. And yeah, I appreciate the opportunity to help anybody, even if you don't end up being a client. I just am in this business because I love helping people figure out their finances.
Yes. Blaine, thank you so much. I appreciate the time you took to speak with me today. And I look forward to the next time we connect. Look forward to the next time we chat. I'm sure we have so much more stuff we can chat about. This
Well,
is
I really
just the tip
appreciate
of
the
the
opportunity.
iceberg.
As you all can tell, it gets incredibly complicated. It's not just as simple as buy a basket of mutual funds and hope for the best.
That's right. That's right. And today we really just scratched the surface, and that's part of what we want here is to get people thinking about some of these things. And if they have in-depth questions, they really should consult an advisor, someone who is an expert in whatever questions they have. So
Without a doubt.
thank you for sharing your knowledge with us. Again, I really appreciate it. And I will be talking to you again soon.
Sounds great. Well, I appreciate the time, Peachy. It was nice talking
All
with
right.
you. Thank you.
You as well. Thank you. Information shared during the show are opinions of the speakers. They are not legal, financial, or tax advice specific to you. Consult your own specialist, attorney, accountant, financial planner, or insurance advisor for your specific situation.